Hi and welcome to today's show, Ask Becky Anything. And I didn't have any questions from anybody. So if you do have your questions, please do send it into the team. Send it to Rebecca at rebeccarobertson.co.uk and I will love to have your questions. So instead, what I've done today is I've made my team send me a voice clip of their most asked question that they get. Hi and welcome to Accelerating Your Wealth with your host, myself, Rebecca Robertson. I'm an independent financial advisor and wealth coach. I'm the director of Evolution Financial Planning, who is also our sponsor for today's show. Don't forget to like, subscribe, share and review this episode. With your help, we'll reach more people who can benefit from the show. If you're somebody that is not sure what to do with their finances, maybe you're working and you're not sure what to do with the bonuses you've got at work, or maybe you started a business and you've got profits and you're not sure what you should be doing to enable you to A, pay yourself more, or B, potentially retire earlier. Maybe you're somebody that's just thinking about, do I overpay on the mortgage? You've received some inheritance. You've got lots of questions around your finances and what to do next. Then check out Evolution Financial Planning, who are regulated independent financial advisors and financial planners that can help you make some of those big decisions in life. So first of all, I have Jenny.
Hi, I'm Jenny. I'm a mortgage and protection advisor at Evolution Financial Planning. A question clients typically ask is, will my credit score affect my chances of getting a mortgage?
Yes, very much so. So Jenny's our mortgage and protection advisor. She's an independent protection advisor at Evolution Financial Planning. And so she knows the answer to this question, but I'm going to answer it for her. Yes, basically. So especially if you have, where you get sort of HP on finance, that will be deducted from your affordability. So if you miss even one little payment, if it's a small payment, that will affect your credit score. If you take out like payday loans, that's often a straight decline and that will all show on your Experian, Equifax. There's different credit scored companies that hold your credit data. So it's good to find a free one of those, just two that are available. There are more. Typically mortgage providers use Experian or Equifax. And you can then get a report. You can also see your aliases, anyone that's associated with you that's on there. It might be that you missed a credit card payment maybe a couple of months ago, and actually it was the bank's mistake, and the loan provider just puts it down as your mistake, and it's showing on your credit report that you've made that mistake. So you'd need to contact the credit company and get confirmation from the individual bank so you can then update your credit file. So all those little things have an impact. So it's not just necessarily you having a high credit score. It's also, what does that look like? What picture does that build? So first time buyers, but if they have no loans, no credit cards, no HP, then they've got no proven track record. It then means that how can I borrow, £200,000, £300,000, £400,000 when I haven't even borrowed £1,000 before? So having a credit card and using it just for odd payments and then clearing it straight away or at the end of the month is a really good idea. It starts to build that better picture that you're reliable, that you're able to build, sort of manage your finances. If you take out a loan for a car, for example, or for maybe furniture or a holiday, I'd hope that you wouldn't take out a loan for a holiday, and you've cleared that off quicker, or you've had a period of time that you've been paying it off and then now it's finished. That looks great, but you shouldn't just take out debt just to take out debt, because you are getting interest charged on it. Whereas if you have a 0% credit card for purchases, and then you're able to clear it at the end of the month at very least, then that's a better way to start to build your credit. I think sometimes you have to be careful not to build on to debt so that then you end up, putting yourself in a position where you might not be able to clear it. But there is that balance. So if you've had a mortgage and you've missed mortgage payments, that will affect your credit score. If you've had a AVC or a CCJ, so that's a county court judgment, that will all go against you, and obviously bankruptcy. But there are lenders, there are more mortgage lenders who will lend to clients with missed credit card payments. They will lend to those with CCJs as long as they're not outstanding and they're more than a few years old. Bankruptcy is a little bit trickier. That's a little bit more limited, but it means that you're paying a higher interest rate because you're a higher risk. So the cleaner you are in terms of your credit rating, the better. Did you know I wrote a book? It's called Accelerating Your Wealth. Funny enough, the same as the show, Accelerating Your Wealth podcast show. But this is 10 ways to accelerate your wealth. It was designed to really help people with their finances in a simple way. So we focus on some key sections around your money mindset, some practical things that can be done with your finances, and allowing you to maximize your money and your future. So if you're thinking, hey, this stuff is interesting, then the best next step for you is to check out the book. It's an Amazon 5-star bestseller. Yeah, I know, it's great, right? Go and check it out. You can buy it on Amazon and have it with you tomorrow for a nice cup of tea.
Hi, it's Katie, client manager for Evolution Financial Planning. A question I often get asked by kind of new inquiries and clients is, should I consolidate all my pensions to one place across a diverse portfolio, or should I keep them with individual providers across separate funds? What's the benefits of doing both?
Okay, so I mentioned this in a recent podcast where I talked about pensions and why we're ignoring them. And pension consolidations is a big marketing piece for a lot of companies these days. I won't mention any names, but they advertise on the tube, they advertise on the television, and they've started to become a bit more of a household name, one or two of them. But with that becomes this... that's what you do. You consolidate all your pensions. And under FCA rules, you shouldn't really just be consolidating for the sake of it if you're moving it into an environment that's more expensive. Future returns are not guaranteed. Investments can go up or down. Past performance is not an indication of future returns. Therefore, you can't say, well, you're going to move it somewhere better, because how do you know? Now, from a risk perspective, you might be moving it from an environment that is not taking enough risk or is taking too much risk. You might be moving it from an environment where you do want to have it more managed, so you can have better oversight and better risk management. There can be other reasons to move and consolidate. But when you're giving independent advice, they're the things that we consider, all of the above, the client's individual circumstances, their risk, their capacity to risk. We're not just saying we're moving it for the sake of it. So it's not a straightforward answer because everyone's pensions and circumstances are different. You wouldn't normally move it from an environment where you are getting guaranteed income or guaranteed benefits into an environment where they no longer exist. And you certainly wouldn't be moving it from a defined, you need to get independent advice whether it's should be moved when it's a defined benefit pension into a non-defined benefit pension situation, which is basically moving it from an environment where you're going to get a guaranteed income at retirement into an environment where you're not. And they're very much more heavily regulated. So this is where pensions start to become complicated, and it's good to get independent financial advice so they can review those individual pensions and see if it's right for you to move. So some pensions with some clients, I will move one and not two others, or I might move all of them. It just depends on the individual circumstances. It's not always a consolidate for everybody, because until you're actually in drawdown and you are going to retire, they don't have to be all in one place. It's more of a management issue. Where I can see that starting to change is next year. There is a regulatory change in terms of inheritance tax. And that means that basically, if you pass away, all your pensions will be included as a part of your estate. Now, it's one thing having to manage multiple pensions when you're in retirement, and then when you pass away, they don't form part of your estate, and therefore your executors and your trustees don't have to really bother too much about them. They just get a payout and you're done. But it's a different thing when you're having to include those as part of your probate process and your estate from a tax and an inheritance tax and probate process. And if someone's got 7 or 8 pensions, that's going to create a huge amount of work for someone. So I can possibly see some changes in regulation in the future in regards to that. But this moment in time, it's always best to individually look at them all and see what benefits are associated with the pensions you're currently in. Okay, next question, again from Katie this time.
Hi, it's Katie again, Rebecca's client manager. Another question I get asked a lot is, how can I start planning for my retirement now? What do I need to do now to ensure that I can retire at my preferred retirement age?
Start investing, start putting into your pension, reviewing the pensions you've got, maximising your position when it comes to your entitlements and allowances, and run some projections based on what you currently have got. So if there's a gap, then start paying more in or paying more attention to what you are paying in to fill that gap so that you can get to that retirement either sooner or with more money. So yeah, having a look at what you've currently got in place is probably the first step. Thank you for joining us on today's show. I hope you enjoyed it, and take care. Thank you for joining us today at Accelerating Your Wealth with your host, myself, Rebecca Robertson. I hope you enjoyed the show. Do subscribe and let us know in the comments any of your thoughts.